Will Trump's Crypto Task Force Committee going to recruit Michael Saylor and Elon Musk and transform the US's balance sheet into a gargantuan MicroStrategy? Will the Trump trade accelerate Bitcoin adoption to warp speed? Bitcoin to the moon? Or is it Mars making moon boys into Martians? Let's discuss. If you are new to the channel, our daily updates are short format summaries of our market perspectives and trading strategies. We are a team of investment professionals leveraging our careers in traditional finance as traders, market makers, and portfolio managers for top-tier institutions, having transitioned to proprietary traders of digital assets. We have developed a methodology combining qualitative and quantitative factors, merging a multitude of theoretical constructs. Our approach translates how the pricing mechanism is influenced by market maker predatory tactics and trading algorithms with a focus on market structure, liquidity, volatility, and time-price volume relationships. Please note, our content is not investment advice, or is this an educational channel. It is intended for entertainment purposes only. If you suffer from analysis paralysis and prefer short-format market perspectives and rationale for our trade setups, stay tuned and enjoy. Yesterday's trading session was nothing short of remarkable, with Bitcoin recording its largest ever intraday price change, catapulting it to a new all-time high, albeit the latter is less impressive as all-time highs have become a daily routine. The prophetic Bitcoin cyclical post-halving parabolic ascent appears to be coming to fruition. Sentiment has moved from positive to euphoric and only one tick away from extreme greed, as indicated by the Crypto Greed and Fear Index. Fueling the 3 Sigma move were idiosyncratic implications of the Trump trade emerging for digital assets, as rumors of Bitcoin becoming a US reserve asset went viral over the weekend, with the US allegedly becoming a structural buyer of Bitcoin to increase its reserves from current 230,000 to 1 million. Simultaneously, rumors of nation-states adopting Bitcoin as a reserve asset imply other countries may look to front-run the US. This sent the market into a bid-only frenzy since rumors surfaced on Sunday. Exacerbating the move into the weekly open, Bitcoin ETFs recorded another record net inflow in excess of $1 billion. This on the back of 3 consecutive sessions of net inflows for a cumulative $3 billion in fresh, low-price sensitivity demand. Even further perpetuating the move was gamma hedging from large participants in option markets as price approached massive open interest in 80K and 90K strikes in November and December expiries. Look to volatility markets for a perspective on smart money's expectations and sentiment. The implied volatility term structure has inverted with shorter expiries repricing implied price moves commensurate with recent price action. Additionally, the skew or volatility smile steepened on increased speculation of out-of-the-money strikes combined with participants rolling positions to higher strikes. The largest volumes traded were in 90 and 100,000 strikes in November and December expiries. Also noteworthy flow-wise from the prior session was the largest block trade of 1,000 contracts in 140,000 strikes June calls. Thus, implied volatility, skew, and the gamma exposure from the distribution of open interest across strikes makes for further susceptibility of price to gap from 90 to 100,000 if the bid-only backdrop in spot markets persists. Looking to market structure and liquidity zones, liquidity to the upside has been sanitized. Thus, the strongest magnets to price are aforementioned open interest concentrations in 90 and 100,000 strike November and December options. On that same token, these levels serve as potential resistance upon arrival. Liquidity hunts will thus occur only to the downside, with our model forecasting high probability inflection points at 85, 81, 75,000. The Friday CME close near 77,000 also functions a potential liquidity magnet to the downside. This being said, the distribution of returns is wide and flat, but skewed to the upside. In terms of strategy, we reiterate our long-term bias to upside prices, but are cognizant of near-term downside risks in this backdrop of heightened volatility. Our model projection of 81.5 thousand by January has been reached prematurely, and our long-term mid-2025 target now on course to overshoot. A recalibration of our model sets the trajectory of price to 102K by December, with diminishing returns to 165K into mid-2025. As price never follows a linear trajectory, we will look to increase our long delta exposure if the opportunity presents itself to increase our long delta exposure at aforementioned levels to the downside. The volatility backdrop is one to which we find compelling to implement option structures which both hedge left-tail risks while harvesting volatility premia. As always, do your own research and analysis. Be safe, and good luck in trading.